All right, now that we know that we can estimate the value of an individual share of stock by taking the present value of all the future dividends that company is ever going to pay to you, the stockholder, I want to take a moment and introduce a special case. In some sense, we could think of this as a shortcut model, but it's only going to be applicable when we're looking at very mature companies. So suppose that we had a very mature company. This company has already really settled into its sweet spot. It's got healthy and predictable earnings, and out of those earnings, it's making a regular dividend payment. So in this special case, we can think about the simplest way to value a very mature company is just to forecast all the future dividends as growing from the next year's dividend. Take a look on the timeline right here. If I wanted to get an estimate for the value today, I forecast next year's dividend. And if this firm is truly mature, and I think that those dividends are going to grow at a constant rate, which we don't have to take too literally, it's more of a normalized or an average rate, it's very easy to predict what those cash flows are going to be over time. Now, what do we know from the growing perpetuity model? I told you this model was going to be our best friend when we got to stock and company valuation. Well, I know if I've got an infinitely lived cash flow stream, and those cash flows are growing at a constant rate each and every year, I can use that growing perpetuity model by forecasting next year's dividend and dividing it by the difference between my equity cost of capital and the growth rate. Only three inputs needed: next year's dividend, my discount rate, and the growth rate. Now, we can also see by manipulating that formula, a quick reminder, the returns that we ultimately get are the sum of the dividend yield and the capital gains rate, which is just going to be the growth in dividends over time. All right, let's take a look at an example to see how we might apply this very straightforward formula. Suppose I wanted to value a single share of stock in the company AT&T. Well, what do I need to input to use that formula? Well, I'm going to need a forecast of their dividend for AT&T in the next year. I'm going to need a forecast of their long-term growth rate in the dividends that AT&T is going to pay. And I'm going to need a discount rate, my equity cost of capital. Well, let's suppose that I've forecasted the dividend for AT&T to be $1.44 in the next year. Based on the risk of this company, I'm looking to earn a return of 8% each and every year. So my equity cost of capital, I've estimated to be 8%. Now, I've got next year's dividend, but what about the future path of dividends? I need a growth rate. I've now done some analysis on AT&T, and let's suppose that I forecast that average growth rate over time is going to be 4% a year. Well, I've got my three inputs that I need across the board. I can now estimate the value of a single share of stock in AT&T by taking that dividend and dividing it by the difference between the 8% cost of capital and that 4% growth rate. Grinding through that simple math, we're going to get an estimate of AT&T's stock at $36 per share. It's as easy as that.